Listen carefully, because something unprecedented has just happened in the silver market. And if you do not fully understand what it means, you could be walking directly into a financial trap that has been quietly built over many years, designed to transfer wealth from those who react late to those who understand the structure of the system. What occurred over Christmas was not a random fluctuation, not a temporary spike, and not a speculative anomaly. It was a moment of unfiltered price discovery that exposed the difference between paper markets and the physical reality beneath them. While most people were celebrating, while Western financial centers were completely shut down and traders were offline, the Shanghai Gold Exchange, the single largest marketplace for physical silver on Earth, recorded silver trading at $82 per ounce, not as a futures contract, not as a leveraged derivative, but as real, deliverable metal-changing hands. At the exact same time, Western price feeds from Kitco, Bloomberg, and brokerage platforms were showing prices in the $74 to $75 range, creating a $7 gap between what silver actually cost in the physical market and what investors in the West were being told it cost. That gap is not trivial, because price gaps of that size in a globally traded commodity do not exist without consequences, and those consequences are rarely evenly distributed. This discrepancy exists because precious metals markets operate across multiple time zones but are not governed equally. True price discovery for silver has long been dominated by futures trading on Comex in New York, a market where contracts are traded far more often than metal is delivered. But on Christmas Day, Comex was closed, London's LBMA was closed, and for 36 uninterrupted hours, Shanghai was the only major exchange actively trading physical silver. During that window, without Western banks intervening, without algorithmic selling programs suppressing price, and without the leverage-heavy paper market dictating sentiment, the physical market spoke clearly, and it spoke at $82. That price represents what silver costs when supply matters, when delivery matters, and when demand cannot be deferred. When New York opens, that $7 gap cannot simply be ignored. It must close, either through Western prices moving sharply higher to meet Shanghai, or through aggressive paper selling designed to force prices lower. And this is where the Monday morning trap emerges, because traders will be forced to react after the move has already begun, not before. This situation has been building for months, driven by a fundamental shift in supply and demand dynamics that can no longer be papered over. In 2025 alone, silver is up 158%, the largest annual gain since 1979, a move that reflects not speculation but structural stress. Physical inventories have collapsed, with Shanghai Futures Exchange warehouses holding just over 531,000 kilograms, the lowest level in a decade, while mints in the United States and Canada have run out of coins and bars, and dealers across North America have been forced onto allocation because they cannot source enough metal to meet demand. At the same time, industrial buyers have no choice but to continue purchasing silver regardless of price, because solar panel manufacturers, electric vehicle producers, medical equipment suppliers, and AI data center operators depend on silver as an irreplaceable input, creating inelastic demand that does not disappear when prices rise. Compounding this pressure is China's impending implementation of the most restrictive silver export controls in modern history, set to take effect on January 1, 2026, which will require exporters to demonstrate an annual production capacity of at least 80 tons, effectively locking smaller refiners and traders out of the international market and keeping the majority of Chinese silver supply inside China. Given that China controls roughly 70% of the world's refined silver, these restrictions represent a dramatic contraction in available global supply, leaving the rest of the world to compete for the remaining 30%, much of which is already committed to existing contracts and industrial use. Against this backdrop, the $82 print in Shanghai is not a speculative bubble, but early price discovery in a market that understands supply is vanishing. And when Western markets reopen, they will be forced to confront that reality, whether they are prepared or not. Now, it is critical to understand why this situation is so dangerous, and why Monday morning has the potential to become one of the most volatile trading sessions silver has seen in decades. And the concept that explains this is backwardation, a condition that almost never appears in a healthy, well-supplied commodity market. Under normal circumstances, futures prices trade above spot prices, because anyone promising delivery in the future must factor in storage, insurance, financing, and opportunity cost, a structure known as contango. But when a market enters backwardation, that structure collapses, and immediate delivery becomes more valuable than future promises, signaling fear, urgency, and a breakdown of trust. In China, silver has been trading in backwardation for weeks, meaning buyers are willingly paying a premium to secure metal today rather than accept a paper promise for delivery months from now, even when that promise is cheaper. And this behavior tells you everything you need to know about confidence levels in the system. The physical market no longer trusts the paper market to deliver, and once that trust is broken, it does not come back easily. This fragility was exposed in dramatic fashion on Thanksgiving night, November 28, 2025, when the CME Group, operator of the Comex Futures Exchange, abruptly halted silver trading for more than 11 hours, officially citing a cooling system failure at its Illinois data center, a claim that raised eyebrows across the market because it occurred in the middle of a powerful rally and during one of the quietest trading periods of the year. What made this event even more suspicious was that on the same morning, the Federal Reserve conducted an emergency repo operation, injecting $24.4 billion into the banking system, a highly unusual move on the Friday after Thanksgiving, prompting widespread speculation that banks needed immediate liquidity to meet margin calls. While no official confirmation exists, the prevailing belief among experienced market participants is that a large buyer, likely based in Asia and possibly in China, demanded physical delivery of a significant quantity of Comex,